Yep, Teladoc shares have lost 29.2% since the beginning of the year compared to the S&P 500's decline of negative 8.8%. What did we learn from Tuesday's Teladoc's earnings call that can calm the panicked mind? Welcome to MGA Investing. My name is Dee. I will have to tell you overall, well, I'm pretty happy with the results. They were pretty much in line with their game plan, and all the key metrics I'm most focused on all continue to improve. So that being said, what's Wall Street so sour about? The stock dropped in after-hours trading on Tuesday night and struggled some more on Wednesday. All I can say is if the bears want the market down, they'll keep screaming and stomping their feet until everyone else believes it. And then, of course, well, they'll come in and start buying. This is not to say that any stock can go straight up forever. And today, Teladoc stock price is firmly planted on the ground, a long way from the rarefied air it once loomed back in February 2021. So what's materially really driving Teladoc stock price down now that we're well past this overbought and overinflated share price? Nothing that I can really see. I guess I'm supposed to buy into the excuse that COVID-19 instigated inflation screwing up the supply chain is the problem. Or is it the increased worker wages driving up prices? But wait, many corporations are reporting great profit margins. Is there a disconnect somewhere? And now we have the Russian-Ukraine invasion that has markets concerned and oil prices rising. It can be difficult to figure out what to believe unless, of course, you're reading the actual numbers. Fortunes are made and lost in the cycles of the market. It was Baron Rothschild that said, the time to buy is when there's blood in the streets, even if the blood is your own. Of course, that's easy to say, much more difficult to do, hence why so few people get wealthy from the stock market. It's not enough to buy low, you have to pick the right companies to buy also. It's hard to buy against the grain, especially if you don't have a solid stock selection process. Wall Street is going to do what it's going to do, but for me, I'm going to stay focused on Teladoc's numbers and their improved strength within my 4 stock analysis criteria I call the dumb method. That includes durable competitive advantage, understanding how the company makes money, and their potential for future revenue growth and profitability, measuring management's effectiveness and converting the company's vision of the company into a viable, profitable business, and determining a reasonable margin of safety for buying the stock. Nothing of what I've heard on the earnings call and what I've read digging through the reports raised any concern that the company was losing any ground on these 4 criteria. But you also have to realize I have a much longer time horizon on Teladoc than most. My outlook now is 5 to 9 years from now, and I'm not trying to win a lottery ticket with Teladoc. I saw a company I liked what they were trying to do within the healthcare industry, felt if they could pull it off, it would be transformative and disruptive for humanity. I then made a conscious decision as a result of reviewing the company using my dumb method and then allocated dollars to help them on this journey as long as our missions were aligned. I'm still in and have accumulated more shares since I began purchasing when it dropped below $175 a share. If you've been watching my channel for a while, you know I follow Monish Pabrai's admonition, heads you win, tails you lose a little, when it comes to certain early, higher risk types of investments where I would absolutely place Teladoc today. Let's dig into some of the numbers. I like this particular page within the 8K because I can see the overall trend of key metrics at a glance. When looking at access fees, these are fees paid on behalf of the employer for the employee. They're also sometimes referred to as subscription fees. We can see the trend up from Q1 2020 through Q4 2021. Take a look at the revenue in Q4 2021. Look at the increase in all the revenues represented in access fees revenue. Total access fee revenue was up 51% in Q4 2021 compared to the same quarter 2020. Seeing continued and consistent access fees revenue increasing to me is a sign of how well the Teladoc sales team is penetrating corporate sales, and it looks like they're actually starting to put a dent in it. The numbers are showing some long-awaited market adoption. Visit fees are fees paid by clients or the members themselves. We see consistent revenue increases in the U.S. and international markets. Total visit fee revenue increased 21% in Q4 2021 compared to the same quarter in 2020. Here's another look at that. When looking at total revenue, it increased 45% from $383 million in Q4 2020 to just over $554 million Q4 2021. U.S. revenue grew 45% to $483 million in Q4 2021 compared to the same quarter. International revenue also grew 40% to just over $71 million over the same period, and total revenue grew 45% to just over $5.54 million. On a full year view, the U.S. revenues grew 94% to just over $1.7 billion International grew 44% to just over $258 million. Revenue increased 86% to just over $2 billion from just a little bit over $1 billion for the year ended December 31, 2020. Access fee revenue grew 104% to just over $1.7 billion. Visits free revenue grew 15% to just over $254 million. All great numbers here, but I know despite the increases, I'll always get a comment that most of the revenue is coming from Livongo, as if that were a negative. I kind of think that was the idea behind the purchase of Livongo. Here's another key metric, average U.S. revenue per member. The bigger Teladoc gets, the more this metric will get talked about, because small dollar movements here over millions of customers means billions of dollars in revenue annually. Take a look at the U.S. average revenue per member Q1 of 2020 and where it ended Q4 of 2021 at $2.49. This is managed revenue growth, and it's going in the right direction. What will company revenues look like at $750 U.S. average revenue per member? Moving down to visits, these are virtual visits. Q4 had a nice 44% increase over the same period last year, and the overall growth was 42% 2020 to 2021. They are now at worldwide visits of 4.4 million. Even after we figure out how to live with COVID amongst us, I just don't see people wanting to go back to in-office doctor visits at levels they did pre-pandemic. The world had seen the benefits of digitally enabled medicine. They can't unsee it. It's here to stay, and it will get better and better. Here's an infographic presented in a recent TED Talk by Sophia Volartis talking about why telemedicine works for both doctors and patients. She explained that a study she reviewed indicated that the average doctor visit was about 121 minutes, about 37 minutes for travel, another 64 minutes of filling out forms and wait for your doctor, assuming the doctor is not behind, all for a 20-minute visit if you're lucky. And that's not even counting if you had to drive to a local pharmacy after the doctor visit. Just think of all the wasted PTO used by Americans and wasted on doctor visits and appointments that could have taken place on a mobile device. I expect as we become more accustomed to living with COVID, digitally enabled care will pull back slightly before it readjusts upward again, which will allow the system to learn, grow, and expand as the world readies itself for the next future pandemic. Another critically important metric to me is utilization. This number, in my opinion, is the EKG of Teladoc. It's one thing to get corporations signed on to buying the program for the first contractual period. It's another to maintain them on the system and to get them re-upped again. Companies won't be willing to pay for a service few of its employees use. Teladoc has to draw the users in to get them to use the service more often. Right now, with COVID, it's been a bit easier to get people to adopt the system where the technological infrastructure permits. As COVID concerns shift to less critical in the US and worldwide, Teladoc must up its engagement game. It's critical that Teladoc continues to integrate its various parts they've gained through acquisition to build out a better consumer value chain experience than could be offered by any single potential competitor to further cement its competitive advantage. This will require some very creative target marketing to current subscription holders to educate and encourage users to touch the system more often for more reasons. We should see this reflected in higher advertising expense throughout the remainder of the year. A move from 16% utilization to 22.7% utilization continues to move the needle in the right direction. Consider that annual utilization Q1 2019 was just 11%. Platform-enabled sessions is where Teladoc's licensed software platform is used to facilitate a virtual voice or video encounter between a care provider and a client's patient or between care providers. Teladoc believes that platform-enabled sessions are an indicator of the value their clients gain from the platform they license from Teladoc in order to facilitate virtual care. These measures weren't being recorded until Q3 2020, and we can see the uptick through the heated COVID quarters and see its return to more normal levels as the pandemic concerns start to level off. Total visits and sessions provided and enabled are up 28% from 4.2 million Q4 2020 to 5.3 million Q4 2021. Also worth mentioning is net loss in Q4 2021. It was only 11 million versus 394 million in Q4 2020, mainly due to lower stock-based compensation expenses, decreases in amortization of acquired intangibles. That's part of those expenses related to the various acquisitions. Other things to note are Q1 2022 guidance revenues projected to be between 565 to 571 million, net loss per share between 30 to 50 cents per share, total U.S. paid membership to grow to 54 to 54.5 million, visit fee only access from 4.3 to 4.5 million visits, total visits 4.3 to 4.5 million. The outlook for Q1 2022 and the full year 2022 look a little soft. Some may even suggest some sandbagging, but I don't blame them for erring on the side of conservative because we really don't know what the world will look like post-pandemic and now that we're facing a potential escalating war in Europe. So on all accounts, the company continues to move in the right direction. We see stock-based compensations resulting from many of the acquisitions over the last few years. We're starting to see that come down, which should continue as the company continues to improve total revenues. As I've said before, doing what Teladoc is trying to do is not easy. It's not been done before, so there's no playbook. But if they pull it off, it will have a significant benefit to healthcare and humanity. Remember, be smart with your investments. When the market looks like it's going to go up forever, anyone can be a stock expert. But it's in these times where you earn or lose your stripes in investing. If you found value in this video, hit that thumbs up and subscribe so you can be the first to get weekly access to real investment information for real investors. Thanks for watching. I'll catch you in the next video.